Casey. I'm the CEO of CoinDesk. It's a pleasure to be back here at the GBBC Lounge. Third time I've done this with you guys. It's always a thrill. And we've got a tremendous panel. We had a good pre-call yesterday that got me excited about this. Lots of interesting stuff to talk about. We have David Newns, CEO of Six Digital Exchange, SDX. We've got Michael Sonnenshein, CEO of Grayscale. We have Elodie Marchi from Kaiko, the head of operations, and we have Tanvi, Singh, managing director at Credit Suisse. I think you'll find what we've got is an interesting perspective from different players within the digital assets and traditional financial ecosystem, where we'll get to sort of talk a little bit about the integration of these two worlds, or the lack thereof, and what needs to happen and where things are headed. So why don't we just start it up and we go down the line and say, from your different perspectives, what needs to happen to see greater integration and sort of the digital asset trading environment start to move forward amongst institutions from here on? David, you can start.
I'll start. Is this working? It is working. So I think first of all, it's important to separate out, or to make a distinction between digital securities, digital assets, and cryptocurrencies. And I think they're on slightly different, they're on different paths. For digital securities, by that I mean digitized securities, funnily enough. So bonds and equities, things that so the traditional being digitized and being traded and settled on the blockchain. For that, the institutional investors essentially need to be able to integrate and adopt the kind of workflows that those digital securities bring benefits around, but at the same time, they are essentially new, innovative workflows for those organizations that are very different to that which they're familiar with. And when we're sort of starting out in SDX, we consider ourselves to be a bit of the tip of the spear when it comes to the actually providing an exchange for trading digital securities in a regulated environment. With a small amount of actual assets available to trade, but a requirement for a different set of workflows and a different integration to be provided for that, to actually support that on the part of the institutions, you have a sort of an economics issue, because you're now running parallel infrastructures, one for the old world, one for the new world. So there's an adoption issue associated with having to make quite a significant investment now to be able to adopt and take advantage of the new technology, while at the same time that having limited use cases until the whole DLT-based financial markets infrastructure becomes a more broad-based sort of a set of innovations and opportunities and areas to participate across the financial markets. So it's a sort of I think the first thing is an adoption curve, which is different as well to the adoption curve we're seeing in crypto. On the crypto side, I would say that one of the major problems is a lack of institutional-grade components within the technology stack for institutions to actually be able to effectively sort of trade and settle and custody these assets. So there are certainly significant emerging players in that particular space, but there's still a degree of confusion as to how I think institutions can really adopt that. And then we haven't even touched on regulation, which varies enormously.
We'll get to all of this. I mean, you've raised some interesting questions as well about this parallel process of development, the costs that go with that. We can dig into that in a moment. But Michael, you're coming at this from a different perspective. You're the biggest digital asset manager in the space. What do you see in terms of the state of institutional integration?
Yeah, so I think we're really talking about two things that'll bridge the gap between where we are today and where institutions ultimately need to be in order to more wholesomely integrate crypto into their investment policies and actually making and putting capital to work. I think those two things are regulation, and I think the other thing is plumbing and infrastructure. So on the regulatory front, I would say that having been around crypto as long as I have, regulators are about as engaged and as educated as they've ever been on crypto. However, what we in the crypto industry are doing every day is constantly innovating, constantly pushing the envelope, new attributes, new features, new use cases. And so as a regulator, that becomes very challenging to keep up with. We do, however, need regulation beyond enforcement. We cannot just continue to call out bad actors, folks that are violating securities laws and things like that, whether it's in the US or abroad. Instead, we need to have new regulatory frameworks that account for digital assets, digital securities, cryptocurrencies, et cetera. All of that will create a landscape that is much more favorable for institutions when they're thinking about actioning investment in crypto. Separate and distinct from that, the crypto ecosystem has also developed unbelievable tools. Trading systems, order management systems, tax lot reporting, indices, derivatives, lending and borrowing. We have the healthiest two-sided market we've ever had in crypto that we have today. All that being said, it exists entirely siloed away from traditional financial services access points. And so over the next, call it 12, 18 months, you're going to see a lot of those bridges, a lot of that plumbing get built out that will really bridge what is being built in crypto and its accessibility with the traditional financial system, which will be a big, big tailwind for institutional adoption and participation.
Great. And Elodie, Kaiko is really a part of that plumbing in some respects. I mean, there you are providing this sort of really important data underlying this. Talk a little bit about the importance of data and that can be applied in an institutional context.
Yeah, absolutely. So yes, Kaiko is a reference market data provider in the industry, and definitely, to your point, like you mentioned regulation and really the plumbing. On my way to Davos, I was thinking yesterday, we talked about the future adoption of institution of digital assets, but actually, why future? In the sense that, if you talked about or trading operations, it's already here, right? Like you heard of Citadel announcing in March. You look at a lot of the different actors already in trading. If now you think of the post-trading settlement activities, that's already happening as well. Like think of all the announcement between HSBC and Wells Fargo talking about like FX settlement on chain. If you think about we had our friends of BIS here talking about the Bank of Switzerland and also the French bank on all the other settlement activities. It's already here. However, there is one thing we said at Kaiko is these are all experimental product. It's not industrial level standard ready. And that's where really what we see here is like data is actually one of the key points that needs to be included. That's kind of the plumbing you were referring to talk about interoperability. You need high reliable, high quality data. This for, end of day basically close. You also need implied volatility and other risk management tools that are specific for crypto. You also need a way to basically have a bigger view of this highly fragmented landscape. If you talk about, some of our colleagues talked earlier about what happened the past couple of weeks with UST, basically, and Terra. The first transaction happened on-chain on DEXs and on protocols such as Anchor. No one saw that coming, right? So in that sense, that's one of the key challenges with is really data to be able to provide this. And that's what we do. That's the gap we're filling today is really to provide this high quality, reliable data that will enable this operation at scale.
Okay, and Tanvi, you're here representing one of the old establishment institutions that we're referring to here. What's your perspective?
Who let her in?
We'll work with all of you. No, it's the digital asset industry at its peak had been at $2 trillion, and the possibility of what the new built infrastructure, as Michael talked about, or the possibilities that SDX provides, of what Kaiko is doing, and numerous other firms that you're seeing here right on the Davos plots have never seen so much representation of blockchain, whether we call it downturn or upturn or the bear markets or the bull markets. It's just amazing to watch the innovation in that space. But the real innovation can only happen when the two words, the old finance and the new finance, kind of meet at a starting point. I completely agree that it cannot stay in a silo, and the banks cannot do it alone, or the new word cannot do it alone. And how do we bridge the gaps between the two is going to be fundamental in the next, not just 12 to 18 months, but for the next 3 to 5 years, in my understanding. And I also agree with my fellow panelists that digital assets and crypto have to be thought into two different brackets. A lot of work is happening, and I can speak on behalf of what's happening within the Swiss industry and the Swiss banking, where regulators are a lot more agreeing, or have given the possibilities of agreeing or disagreeing, and making a fully regulated crypto exchange, a digital asset exchange, with SDX in here. So what's going to be important for the future of institutional adoption is for the banks to now play their role to help build the infrastructure. We saw how hard it was just for the little bond offering that we did together with SDX back in November last year. The subscriptions were overwhelming. I think the previous panel was talking about of how excited our clients are. That's where it all starts, where the hunger comes from, where the need for the new industry comes from. We are 2.5 times more subscribed than we were for a regular bond offering. But again, going back to David's point, the two infrastructures are completely different. The banking industry goes from a quarter to quarter. So how do you bring in the investment to be able to utilize, to benefit, and to recreate the new infrastructure with the support of all the other big institutions doing their own pieces.
It's not because of a lack of opportunity when you break it all down. I mean, you've got some numbers as to what could be the potential savings for institutions if they were to adopt, T0, DLT-based systems, and so forth.
So we, as banks, we are very comfortable right now with our T+2, and anytime we make an improvement to get these numbers smaller, it feels like a big innovation. But what these guys do out here is T+0, it's real time as it happens. Beyond the benefit in terms of efficiency of settling a certain trade at a T+0, which is almost real time with some seconds of a delay, it also gives the benefit of all the regulations, the older regulations with MiFID that costs us a huge amount of money, the post-trade, the reconciliation, a lot of manual work that goes in, and that kind of increases the cost of how the banks operate and the efficiencies across the board. I mean, the last I checked, since the MiFID regulations have come in, the overall cost of the banking industry and of the asset managers have been an upward of $140 billion. So that's a huge number. It continues to keep increasing, but it would need effort and time. And in my perspective, next 3 to 5 years, at least for some of the bigger banks to start benefiting from the big infrastructure.
So David, though, with those numbers, with those opportunities, why aren't banks rushing into other institutions bankracking, and what's stopping them from taking advantage of this?
What indeed? So what Tanvi is referring to is, that the cost of settlement, is in the hundreds of billions of dollars on an annual basis across the globe. That is when you have decided to trade a securities transaction on an exchange, we have this highly optimized T+2 settlement cycle, which also has a requirement around collateralizing your membership of a clearer. You have counterparty risk associated with that clearer as well. And in addition, you have settlement failures associated with getting reconciliations wrong throughout that T+2 cycle. So what we did with STX and leveraging the blockchain technology is enable instantaneous settlement. So we now have what we call the atomic swap. So trading and settlement and payment are all a single indivisible step. You cannot do one without the other. So it happens instantaneously and bilaterally between counterparties. So we've eliminated the need for a central clearer, or a clearinghouse, any need for collateral be posted at the clearinghouse, and any of these, and any reconciliation required down that multiple sort of step path towards ultimately delivery and payment. So I think so it is a very exciting and really, really cool innovation. The challenge associated with adopting that is that that's a completely different way of settling securities transactions to how it's done today. And that requires, therefore, a different set of workflows within the organization. And in addition, it does require this concept of pre-funding all your trading, which is something which is very familiar in the crypto space because instantaneous settlement is very familiar to those who are trading crypto assets because that's how it works there. But it's very unfamiliar in the traditional securities space. So that's one of the issues, and then the other issue is simply getting your head around blockchain and getting your head around how that actually functions, and ensuring that from a risk perspective you're comfortable to onboard onto these platforms in the first place. So there is that, and then there's, as I mentioned before, the sort of the singularity of use case, the fact that you have sort of SDX as the first regulated FMI that offers this functionality on the blockchain, means that the cost of actually the cost benefit ratio is pretty extreme. It's sort of extremely disadvantaged given the savings you're going to get, but for very limited numbers of very limited activity for the time being.
So we need mass adoption or much larger scale of adoption to actually have the payoff.
I want mass adoption.
But how do you get there? This chicken and egg thing.
Yes,
so Michael, I mean, is it up to your industry to build those bridges? Because the siloing of practices is not only endemic to the traditional financial industry. Crypto has its own ways and behaviors as well, right?
Yeah, I want to touch exactly on that, and also just back to the title of this panel being the future adoption of digital assets and crypto. When we think about, and this makes headlines and it makes for good conversations, there is such an obsession with getting institutions involved in digital assets and crypto. And everyone's obsessed with institutions because they're the deepest pockets, they throw the most weight around, et cetera. But in I'm sorry. but in having worked for these institutions myself and having sat in crypto for the last 8 years, there are some fundamental shifts taking place that are causing a lot of these institutions to remain largely asleep at the wheel. Number one, the human capital. So human capital is shifting out of traditional financial services firms that would in fact be the financial institutions that are adopting crypto and digital assets, and they are joining companies like mine and most of the companies represented on this panel. You also have an inability or hesitation to innovate, and you don't have an agility that you usually see in the crypto ecosystem. And I think a lot of the times we get so caught up on institutions when actually we think back to crypto's roots and the fact that it was really created in essence to hopefully foster a more inclusive, equitable financial system, right? And so when we think about the ups and the downs of Bitcoin at 60,000, 30,000, et cetera, these are certainly important movements in the overall market. But ultimately, in a world of wars, hyperinflation, geopolitical tensions, et cetera, we're actually moving towards a future where demographic shifts are taking place that can actually allow crypto to get into the hands of the next 100 million, the next 500 million people around the world and actually create a better society overall. And so institutions may or may not be a part of fostering that growth, but ultimately if we look at kind of this as a new layer of the internet, rather than just something that's going to displace everything else that's out there, we are in fact unlocking totally new use cases that really can create this more equitable financial system.
So Elodie, we sort of just from all this conversation, seeing almost like two parts here, this big dramatic change happening in the crypto and digital assets world, and a kind of inertia, albeit with some experimentation and activity happening in the institutional side. So almost like two forces butting up against each other. How do we move the needle? What are the things that we could do? Because you're not going to have a wholesale change in these deeply entrenched systems, but there's got to be areas where changes can be made.
I completely agree. I think, in my opinion, you want to have you shouldn't forget that digital assets, you have a lot of different pockets basically in this, but that's sort of different use cases. And so in my opinion, you just need to think through, what do you need to first, we need to be pragmatic. This technology, distributed ledger technology, can really help us solve a lot of the challenges that we haven't been able to solve so far. And just don't forget that each digital asset can be leveraged in different capacity. We haven't talked yet on this panel about permission and permissionless blockchain. One thing that some digital, I would say, or finance institutions are having a hard time to wrap their heads around is really how do we do in this environment that's not controllable, where we don't really see, how can we get all our MiFID and all the reporting and regulations anchored. Don't forget that there are some blockchains that are permission, and in my opinion, we'll end up in a world where you have a lot of interoperability. You won't have just one ecosystem in silo. It will be really just going to, for what's the best digital asset for what use case. And we'll see, TradFi and digital finance collaborating, I would say. And we should really think about this way and just leveraging the technology into the best use cases and thinking about how do we get an interoperable system, a multi-chain system that allows you to really solve each challenge with what's best in the market.
But at the heart of the persistent desire of institutions to maintain permissioned structures as opposed to permissionless seems to me it's partly regulation. There's a lot of things that they just can't do that a permissionless blockchain would compel them to do. But there's also control. There is this idea that you're giving up control when you move to these open systems. So from your perspective, from the inside the belly of the beast, Tanvi, how does that balance work? Is there a desire to actually embrace the open? We talked in the previous panel on the DeFi, but if you do open everything up, it's a all boats rise, exciting moment. The internet grew without silos. It grew, at the moment when it was actually sort of all opened up. What's the bank's perspective on that?
So I have to balance the weight of the other panelists to my weight on the institutional side. I think it's about accountability. The way the regulations are currently being set up, or the supervisory bodies are being set up with the first, second, and the third line of defense, is to make sure when things go wrong, there is somebody accountable in the process. And perhaps, as Michael says, the regulations are going to change in a way that we would establish a monitoring system where it is not necessary to point who's wrong when something goes wrong, and the process takes care of itself. And the clients who we are serving are benefited for, are accounted for if if there is a challenge in the system. But at this very moment, the regulations that the banks have to adhere to have to point to accountability. And for that reason, permissionless is not an option. But at the same time, when we talk about permission and permissionless, I think one of the misnomer people have when they talk about digital assets is it's used by negative players for a lot of ransomware, or if it's used for the dark web, and you can never find out who has taken and stolen the money. Amongst many, many examples, and having worked in the AML financial crime space, it's super hard to find your beneficial owner when you are trying to look at the SWIFT system after the first, second, third, or the fourth hops, which is not the case with blockchain. And I believe Elodie can relate to having an interpretation on the blockchain data where you can effectively figure out who the beneficial owner is. So it actually protects against AML, against the financial crime. So from that aspect, it's really, really important that blockchain as a technology is being used also when it comes to regulation. But the friction point at this very moment is where is the accountability, and henceforth permissionless is not an option.
Elodie, just maybe pick up on that, because it does seem that a persistent barrier is this misperception, or at least the misinformation, maybe it's disinformation, deliberate, I don't know, but that you've got all these great money laundering risks and so forth, when in fact the story is very different to the way that Tanvi was describing it.
I would agree. I mean, and just to piggyback on that, accountability is, if you think of a smart contract, it's all programmable, right? So you exactly know who is accountable for doing what in the equation. And so I think there is a lot of education maybe to be done if the word is not out there, that working within even if you work in a permissionless environment with smart contracts, like you can have transparency, and that's actually the goal, and accountability in the systems. And if you need more security or more control, like you can have a corporation basically, or interoperable models where if you need security in permission system, you can have this working with a permissionless one.
Okay. Before I open it up to questions, I just want to touch on the regulations thing a little bit more, because it is, I think, no coincidence that we have two Swiss companies on this panel. Because, we discussed this yesterday, there is this favourable framework that FINMA has created, which has allowed SDX to thrive and to have banks like Credit Suisse start to experiment on that. I'd like you guys maybe to explain a little bit about why that was significant. I'd love to hear Michael's response on whether this is actually posing a threat to the US, that there are these jurisdictions that are creating these friendlier environments. So just give us a little bit of a background about what FINMA has done that's enabled SDX to start building as it does.
Yeah, so starting from a standpoint of being a highly regulated entity as SIX Group, providing the national financial markets infrastructure for Switzerland, there was always an expectation that we would, if we were to deploy something in the digital space, it would be regulation first, and then leveraging the technology as sort of through a lens of regulation. So I think for FINMA, what they needed to understand was how would we address how our technology would address all the risks. So how leveraging blockchain would actually how we'd address the risks that they identified as being associated with new technology. So it was very educative for us working with FINMA to sort of really understand where their areas of concern were, and ensuring that we similarly educated them about how those were addressed with the technology that, for instance, this is a permission blockchain. This isn't Bitcoin. This is us using blockchain in a very different use case. And kind of getting there, I think, meant that the comfort level that they ended up with around the new technology has enabled them to then leverage that knowledge and expertise in other use cases. I think also beyond that, we have the SMB as policymakers, working very closely with organizations like SDX and the BIS Innovation Hub on CBDC experiments. So again, understanding from a regulated perspective and through a legal framework, how would a CBDC work when you're running on a platform such as SDX for managing the issuance and settlement. So I think it's that sort of coming at it from the regulatory perspective outside rather than coming outside in, sort of seeing what we can get away with and getting fined later.
And tell me, what did the banks need in that? I mean, what gave... Talk through a little bit about what you needed to be able to feel the confidence that you would be compliant as you were participating in these...
I think the SDX getting their fully licensed FINMA attestation was huge, because then it was not for the banks to realize what regulations they have to follow and not. So we were more focused on testing out the infrastructure, as we just talked about on the digital bond offering. as an experiment, but to continue on. So you do have a pre-production set available for you. We're not in a sandbox where you're experimenting with technology or pre-prod, which is getting you so much more closer to get to mass adoption of the technology. And we automatically see interest from our clients. So that was really, really helpful with STX getting its license because the bank did not worry about the regulations.
So you kind of remove the regulatory risk element for the banks, which, Michael, sounds like something. I mean, regulatory risk seems to be like the theme of being not only in crypto, but in being traditional finance in the United States these days. So, like, and in that context, right, if jurisdictions like Switzerland end up like just streaming ahead with these sorts of technologies, you know, does this pose a threat to Wall Street? I mean, do we get a migration of capital to places outside of New York?
I think it's certainly possible. When we think about, you know, the perspective that we have being in DC, working very closely on the U.S. regulatory front, there's a tremendous opportunity for the U.S. The White House put out an executive order a couple of months ago that really called into action all of the federal agencies in the U.S. to really engage on these exact type of issues and develop frameworks and policies and really begin to think about how they're going to engage on this. But underlying that in a very overt way was also these themes around American competitiveness, America being, you know, New York being the financial center, most important financial center in the world, and, you know, not squandering innovation. It's too early to say what's going to come out of the White House executive order, but certainly from an industry perspective, we, I think, digested that as at least neutral, if not kind of neutral to positive, because it could have been quite prohibitive, you know, if it didn't land the way it did. Similarly, you saw in the UK not all that of a differentiated proclamation around making the UK a hub of crypto innovation, wanting to keep onshore, you know, businesses, jobs, tax revenues, et cetera. And so there is going to be a little bit of a race between different regimes as to who is going to be most accommodative or who's going to be most prohibitive around these technologies. The Swiss have certainly put a good foot forward on this and are out in front of a lot of other geographies. You just saw some very favorable guidance come out of Germany in the last week or two around taxation of digital assets. And if we continue to kind of trot around the globe, you'll see really and truly a patchwork. Ultimately, though, you know, I was having a conversation about this morning. The question came up was, well, does the U.S. care what the rest of the world is doing? And I'd largely say it does not. The U.S. really, I think, is focused on protecting its interests, protecting American investors, and you know, making, you know, good, sound policy decisions. On the flip side of that, though, many other jurisdictions around the world are watching what the U.S. is going to do around the development of regulation and new policies. So we are at an interesting inflection point around a lot of these dialogues with regulators and policymakers.
Yeah, it's all very well to just care about your own until you can no longer afford to do so, right?
Yeah, John Arundel from Washington, D.C., and I work with a lot of crypto companies in the United States, and of course the regulatory risk was quite severe under the Trump administration. It seems to have loosened up a little bit under President Biden with this new memorandum. I'm just wondering how you all feel about the regulatory risk to digital assets and crypto.
I think it depends on what you're doing within the crypto ecosystem. We've positioned ourselves as a ask for permission, not for forgiveness kind of an organization with regulators. But time and again, you are still seeing enforcement actions being taken out against certain actors within the U.S. And what we're really calling for is regulation beyond enforcement, right? We can't continue to develop products and services as a business solely by looking out for the mistakes that others before us have made. We instead need entirely new frameworks to kind of charge forward and develop those types of, again, products and services.
I can speak. So Kaiko, we're headquartered in Paris, but we also have offices in New York, London, and Singapore. We've been actually working with the European Union. Like we do believe also that, you know, more regulation will help to have more visibility, will, you know, help like spread the usage basically. And so it will actually help the institutions to get into the place, and then it's a virtual cycle, I would say. Or if you talk about adoption, that will definitely move the needle. We're trying to work with the European Union to bring more visibility across all countries to make it a more stable, basically, place. We're not directly affected by regulation. I think it's back to what you said, like depending on your business, basically, like we're all affected differently by those rules. But we believe that we need some regulations just to help institutions get more visibility and enable like to build their services across different countries. And it's a global question, right? It's not just, I mean, companies are not, we talk about DeFi, right? We're decentralized, you have people remote like everywhere. It's not about like one country. It's really about like how can we think about a global solution that will enable you to move like from one country to another. That's something that we shouldn't forget. I mean, regardless, you're like in the US, in Europe, like in Asia, we're talking about decentralized companies. So it's not about like one regulation. It's like how do we talk to each other and how do we work together?
So I think to your point previously, Michael, about sort of does Switzerland have a sort of differentiation as a result of the regulatory environment? I think that is. I think we're benefiting from the fact that there is clarity around regulation and the fact that SDX did get its license within this particular regime. The next member we're onboarding onto SDX is CM Equity, which is a European Union, a German-based bank. So we're seeing that sort of international reach already. So I definitely see it as being an advantage. So so for Switzerland, like there is some benefit to the US still having issues around regulatory clarity. I'm afraid.
Praying for American intransigence. All right, so
can I add like one last statement? But to answer your question, Americas is really key to get the regulations right, because any big institution, because we're talking here an institutional adoption, which is going to be global in nature. So if you do not know what your regulations are going to be in the dollar market, it would be very hard for any of the digital asset settlement to be effective. We can do pilots and we can do all kind of production-ready environment for the Swiss market alone, or for the Malta market alone, or for the Germany market alone. But for it to be really effective, to Elodie's point, you need really global ways of dealing with this currency, because it has no borders. So regulations play a big role.
No borders.
Hi, Matteo Peruccia from Wave Financial. We're an active digital asset manager. So I'm curious on the two of your views on the fact that so much of regulation is really, will be, in my opinion, ineffective if we look at just the instruments being regulated and not the infrastructure or the technology without the instruments. And so you have, the case of custody, we have the case of exchanges, we have the case of asset management products. And how do you see the community working together? My impression has been it's been very siloed in terms of the custodial community trying to get regulation for custody, the investment management for investment management. So have you had any examples, or do you see jurisdictions or industry groups that are working together to try to get a more holistic approach to regulation?
Yeah, I mean, I'll offer somewhat of the U.S. perspective. A lot of the pressure that's being mounted in DC around these issues come through organizations like GBBC and other trade associations, think tanks, et cetera. There is, though, while I would overall characterize the crypto ecosystem as being highly cooperative and one that's highly inclusive, and folks do have a willingness and a desire to help one another and open source blockchains and projects and things of that nature, that a lot of people are being driven primarily by what their commercial interests are. And so they are putting their own, differentiated products and services in front of regulators. That being said, I think the two largest issues that keep coming up in our conversations are, well, how to regulate, digital asset exchanges, right? There can't really be regulated the exact same way that securities exchanges are regulated today. And the other is greater clarity and definitions around tokens and protocols themselves, right? And there isn't one square box that each of them nice and neatly fits into like a regulator would like it to. And so I think until we can kind of push the envelope and get clarity around that, you're going to continue to see people, running afoul of existing rules and regulations, going to have enforcement actions taken against them. And unfortunately, it does mean for businesses that they're going to have fits of starts and stops in order to kind of adapt to the changing environment.
So time for one more quick question.
I have one response to that, which is just very quickly, which is that the digital securities that are listed on SDX are legally identical to a non-digital security. So that's how that works.
Okay, that was nice and succinct. All right.
So Al, you're Protura Capital Maybach. So all in on crypto, but I'm also on the board of a automotive company. And one of the problems, for instance, with electric cars is that obviously there's just less margin, so they don't want to shift as quickly over to the electric cars. Do you think that's the same way with the regulators that if you shift over too quickly to digital assets, that a lot of the inefficiencies that create jobs will disappear and it'll exacerbate the system.
We talked about this yesterday, right? The human capital problem of innovation, right? It's the innovator's dilemma almost.
And
Right?
perhaps I can take the answer. The two aspects. One is when we talk about the efficiencies of the infrastructure, it wouldn't happen in a quarter. It would happen in years. And banks traditionally run quarter by quarter. So there is a time period gap between how that actually effectively works. So and the second part is I don't think anybody's trying to save jobs because it feels that people are going to be retrained in the new kind of jobs that would come in. And from my perspective, I feel the employees within the bank, the management looking forward is looking to revamp those people to do the new jobs because you can imagine somebody sitting in Pune or someplace in India trying to do reconciliation or in Poland. That's a really nasty job to do. It's very, very hard to motivate yourself to do something like that. So it's not trying to protect people. It's the time it will take to roll back into something more innovative. And that, I think, is the bigger friction in the point where there is interest from also the big banks, especially when it comes to the digital infrastructure.
And if I can add to that, just on this point, I like to do the parallel between what we're seeing now in the DLT technology, how it's really changing and being a revolution for the financial system. It's really changing the way we operate in the financial stand. You can compare this to how Internet Web 2.0 really changed and enabled the exchange of information, and how this created a lot of new jobs. Right? We're in a digital world. Like COVID, the pandemic only accelerated all of this. What Web3 is bringing is the exchange of value. So in a very more nimble, fluid way. So sure, there will be some drastic changes, but the digitalization of the world has already started to bring those anyways to the surface. And it's, as always, we're kind of revolution or changes. You will see some jobs disappear, but you will also see a lot of new jobs with added value, I would think, being created. And that's where a lot of people have to adapt and be more in the advising piece versus in the execution. That's where we see a lot of other new value being created with this change in operating structure.
All right, we're going to wrap it up there. How about a round of applause for this tremendous panel? Right.